If you had invested just $10,000 in Nvidia back in 2019, you'd be sitting on over $500,000 today. But here's what nobody's talking about. The same pattern that created those millionaires is happening right now in a completely different sector, and most investors are completely missing it. What's happening right now in the AI chip market is eerily similar to what happened in the early days of the internet, or the smartphone revolution, or even the personal computer boom. And just like those previous technological shifts, the companies that enabled the revolution made more money than the companies that became household names. Nvidia didn't just ride the AI wave, they built the surfboard everyone else is standing on. But that playbook is now being copied in industries you probably haven't even considered yet. Stay with me because by the end of this video, you're going to understand exactly where the smart money is moving next, and more importantly, how to position yourself before the crowd catches on. We're going to break down three specific sectors where the Nvidia pattern is repeating itself right now, and I'm going to show you the exact characteristics you should be looking for in your next investment. Let's start by understanding what actually made Nvidia investors rich, because it wasn't luck, and it wasn't just being early. There was a very specific set of conditions that created that explosive growth, and those same conditions are assembling right now in other markets. Nvidia's success came down to three critical factors. First, they had a product that was essential infrastructure for a massive technological shift. Second, they had a moat that was extremely difficult for competitors to cross. And third, they were positioned at the intersection of multiple growing industries, not just one. This is crucial, so let me break it down. When AI started taking off, every single company trying to build AI models needed GPUs. Not wanted them, needed them. There was no alternative. Nvidia had spent decades perfecting their technology for gaming and scientific computing, and suddenly, that expertise became the foundation of the entire AI industry. They weren't just selling a product, they were selling the only tool that could do the job at scale. But here's where it gets interesting. Nvidia didn't become a $500 billion company just because of AI. They were already dominant in gaming, they were essential for data centers, they were critical for autonomous vehicles, for scientific research, for cryptocurrency mining. AI was just the catalyst that made everyone realize how valuable that diversified infrastructure really was. Now, let's talk about the moat. It's not just about having good technology. Nvidia built an entire ecosystem around their chips. They created CUDA, a software platform that made it incredibly easy for developers to use their GPUs for complex calculations. Once developers learned CUDA, once they built their entire workflows around it, switching to a competitor became almost impossible. Even if someone built a chip that was technically better, they'd have to convince entire industries to abandon years of accumulated knowledge and rewrite millions of lines of code. That's a moat. So when we're looking for the next Nvidia, we're not just looking for the next hot tech company, we're looking for companies that are building essential infrastructure for multiple industries, that have deep technical moats, and that are positioned at major technological inflection points. And I found three sectors where this exact pattern is emerging right now. The first sector is energy infrastructure, but not in the way you're thinking. Everyone talks about renewable energy, solar panels, wind turbines, electric vehicles. Those are the consumer-facing products, the Teslas and Apples of the energy transition. But just like Nvidia made the tools that powered AI, there are companies making the tools that power the entire energy transition, and they're flying completely under the radar. Think about what's actually required to transition the global economy away from fossil fuels. It's not just about building more solar panels. You need to completely rebuild the electrical grid. The current grid was designed for centralized power generation, where electricity flows in one direction from massive power plants to your home. But renewable energy is distributed, intermittent, and bidirectional. People with solar panels are now producers and consumers. Electric vehicles are mobile batteries that can feed power back to the grid. This requires a completely different infrastructure. The companies building the software and hardware to manage these complex distributed energy systems are positioned exactly like Nvidia was before the AI boom. They're creating the essential infrastructure that every utility, every building, every electric vehicle charging network absolutely needs. And just like CUDA created lock-in for Nvidia, these companies are building platforms that integrate so deeply into energy infrastructure that switching becomes prohibitively expensive. Here's what to look for specifically. Companies that provide grid management software, demand response systems, and energy storage optimization. The key is that these systems need to work across multiple energy sources and multiple use cases. A company that only does solar management is too narrow, but a company that manages solar, wind, battery storage, EV charging, and can optimize across all of them while integrating with existing grid infrastructure. That's your platform play. The numbers here are staggering. Global investment in grid infrastructure is projected to exceed $2 trillion over the next decade. Not in solar panels, not in wind turbines, in the systems that make those things actually work together. And right now, there are maybe half a dozen companies worldwide that have the expertise and market position to capture significant portions of that spending. The second sector is even more fascinating because it's completely invisible to most people, and that's quantum error correction and quantum networking. Now, stay with me here, because I know quantum computing sounds like science fiction, but the investment opportunity is very real and very immediate. Everyone's heard about quantum computers and how they're going to revolutionize everything from drug discovery to cryptography. But here's what nobody tells you. Quantum computers are incredibly fragile. The quantum states that make them powerful only last for microseconds before errors creep in and destroy your calculations. Building a useful quantum computer isn't just about building more qubits. It's about building error correction systems that can detect and fix those errors faster than they occur. This is a massive infrastructure problem, and it's creating the exact same dynamic that made Nvidia investors wealthy. The companies that solve quantum error correction aren't building quantum computers themselves, they're building the essential technology that makes every quantum computer viable. And just like Nvidia's GPUs worked across AI, gaming, and scientific computing, these error correction systems work across every type of quantum computer, regardless of the underlying technology. But here's where it gets even better. We're not waiting for quantum computers to become mainstream for this to matter. The race for quantum supremacy means that governments and major tech companies are pouring billions into quantum research right now. IBM, Google, Microsoft, Amazon, they're all building quantum systems, and they all need error correction. The companies that own the intellectual property and have the technical expertise in quantum error correction are already generating revenue and signing long-term contracts. What makes this particularly compelling is the convergence with another critical technology, post-quantum cryptography. Our current encryption systems will be completely broken by quantum computers. Every bank, every government, every communication system needs to upgrade their security before quantum computers become powerful enough to break current encryption. This creates urgent, massive demand for both quantum error correction and quantum-safe security systems, often from the same companies. Look for companies with patent portfolios in quantum error correction, partnerships with major quantum hardware developers, and ideally, companies that are also positioned in quantum networking. Quantum networks will be essential for connecting quantum computers together and for creating unhackable communication systems. This is infrastructure that's being built right now, and the companies building it are at very early valuations compared to where they'll be in 5 years. The third sector is perhaps the most overlooked and yet the most certain to generate massive returns, and that's advanced materials for semiconductor manufacturing. Here's the reality. AI, quantum computing, electric vehicles, renewable energy, all of it requires semiconductors. But we're reaching the physical limits of how small we can make traditional silicon chips. The cutting-edge chips today are built at 5 nanometer scale, with 3 nanometer and even 2 nanometer processes coming online. At that scale, you're dealing with features that are only about 10 atoms wide. This creates an enormous materials science challenge. You can't just use regular silicon anymore. You need new materials, new photoresists for lithography, new dielectrics, new metals that can conduct electricity through features that are barely larger than molecules. And the number of companies in the world that can manufacture these materials to the required purity and precision is vanishingly small. This is the ultimate picks and shovels play. Nvidia needs these materials. Intel needs them. TSMC needs them. Samsung needs them. Every semiconductor manufacturer in the world is completely dependent on perhaps a dozen specialized materials companies for the exotic chemicals and materials that make advanced chip manufacturing possible. And unlike chips themselves, where there's intense competition and rapid obsolescence, these materials companies have genuine monopolies or duopolies in their specific niches. What makes this even more compelling is that demand is accelerating faster than supply. Building a new advanced materials production facility takes years and hundreds of millions of dollars. The barriers to entry are enormous because you need both the chemistry expertise and the ability to manufacture at incredible scale with near-perfect purity. A single particle of contamination can ruin an entire batch of semiconductors worth millions of dollars, so semiconductor manufacturers are extremely reluctant to switch suppliers even if someone else offers a lower price. The companies to look for here are the ones supplying photoresists, which are the light-sensitive materials used to pattern chips, ultra-pure chemicals for cleaning and etching, and specialized gases for deposition processes. The key metric is exclusivity. If a company is one of only 2 or 3 global suppliers of a critical material, and that material is required for cutting-edge chip production, that's a structural advantage that can persist for decades. Now, let's talk about how to actually think about timing and valuation in these sectors, because this is where most investors make critical mistakes. The Nvidia millionaires weren't the people who bought at the absolute bottom. They were the people who recognized the pattern and held through the volatility. Understanding this is crucial for what comes next. When Nvidia first started its massive run, there were multiple times when the stock pulled back 20, 30, even 40%. Every time that happened, there was a chorus of analysts saying it was overvalued, that the AI hype was overdone, that competition was coming. And technically, they weren't wrong about any of those things, but they missed the bigger picture, which was that Nvidia was building a compounding moat in an expanding market. The same thing is going to happen in these sectors we've discussed. There will be pullbacks, there will be negative headlines, there will be moments when it feels like you made a mistake. But if the underlying thesis is sound, if the company truly is building essential infrastructure with strong moats in growing markets, then those pullbacks are opportunities, not warnings. Here's my framework for thinking about valuation in infrastructure plays. Traditional valuation metrics like price-to-earnings ratios can be misleading because they don't capture the option value of being positioned at a technological inflection point. When Nvidia was trading at a PE ratio of 50 or 60, value investors said it was insanely overpriced, but they were valuing it as a gaming chip company, not as the infrastructure provider for the AI revolution. Instead, focus on these questions. First, is the total addressable market genuinely expanding? And is it expanding faster than the company's valuation? Second, is the company's market position strengthening or weakening? Are they signing more partnerships, filing more patents, increasing their pricing power? Third, what would it take for a competitor to displace them? And is that scenario realistic in the next 5 years? If the market is expanding, the position is strengthening, and displacement is unlikely, then temporary overvaluation doesn't matter much. You're not trading, you're compounding. And the returns from compounding in infrastructure plays can be absolutely extraordinary because the growth is persistent rather than cyclical. Let me give you a concrete example of how this played out with Nvidia. In 2018, there was a massive crash in cryptocurrency prices, and Nvidia's stock fell by half because everyone assumed their growth story was dead. Gaming was mature, crypto was collapsing, and the AI story was still speculative. But if you looked at the underlying dynamics, Nvidia was actually strengthening its position. They were investing heavily in AI-specific chips, expanding CUDA's capabilities, and signing partnerships with cloud providers. The market was focused on short-term revenue fluctuations, but the smart money was focused on market position. The same dynamic is playing out right now in the sectors I've outlined. Energy infrastructure companies are getting hammered because interest rates are high and renewable energy projects are getting delayed. But the underlying build-out requirement hasn't changed. It's just been pushed out by a year or two. Meanwhile, these companies are using this time to strengthen their technology, expand their partnerships, and consolidate market share while competitors struggle with financing. In quantum error correction, you're seeing wild volatility because the sector is still speculative and prone to hype cycles. But underneath that noise, the serious players are making real progress, signing real contracts, and building real intellectual property moats. The volatility is a feature, not a bug, because it creates opportunities to build positions at favorable prices. Advanced materials companies are actually the most stable of the three because they have existing revenue and profits. The opportunity here is that the market is dramatically underestimating how much incremental demand is coming from the acceleration in semiconductor innovation. These companies are being valued as if they're in a mature, slow-growth industry, when in reality they're about to enter a period of sustained high growth driven by technology requirements that have no alternative solutions. Now, I want to address something important that a lot of investment content ignores, and that's the psychological aspect of holding through volatility. Making money in infrastructure plays isn't intellectually difficult. You find companies with structural advantages in growing markets and you hold them. But it's psychologically brutal because there will be moments when you're down 20 or 30% and everyone around you is saying you're wrong. Here's what helped Nvidia investors hold on, and what will help you hold on to the next generation of infrastructure plays. You need to have a clear thesis written down, ideally before you invest, that outlines exactly why you believe this company is positioned for long-term success. When the stock drops and the doubt creeps in, you go back to that thesis and ask, has anything fundamental changed? Not the stock price, not the headlines, but the fundamental reasons you invested. If nothing fundamental has changed, if the moat is still there, if the market is still growing, if the competitive position is still strong, then you hold. In fact, if nothing fundamental has changed and the price has dropped significantly, you buy more. This is how Nvidia millionaires were made. They had conviction in the infrastructure thesis, and they used volatility as an opportunity rather than a warning. The second psychological tool is diversification within the theme. You don't need to pick the single winning company in quantum error correction or advanced materials. You can build a basket of 3 to 5 companies in each sector that all fit the infrastructure criteria. This reduces individual company risk while maintaining full exposure to the sector thesis. If one company stumbles but the sector thesis plays out, your portfolio still does extraordinarily well. Let me also be direct about the risks here, because every investment has risks, and pretending otherwise is dishonest. The biggest risk in infrastructure plays is technological disruption. What made Nvidia vulnerable, at least theoretically, was the possibility that someone would develop a completely different approach to AI computation that didn't require GPUs. It hasn't happened yet, and it looks increasingly unlikely, but it was always the tail risk. In energy infrastructure, the risk is that energy transition happens slower than expected, either due to political changes or technological setbacks. In quantum, the risk is that practical quantum computing takes longer to arrive than current projections suggest. In advanced materials, the risk is that semiconductor innovation plateaus or that new manufacturing techniques reduce the need for exotic materials. These are real risks, and they're why you diversify and why you only invest money you can afford to have locked up for 5 to 10 years. But here's the key insight. These risks are mostly about timing, not direction. The energy transition is happening. It's a matter of when, not if. Quantum computing is coming, even if it takes longer than optimists predict. Semiconductors will continue to advance because the economic incentives are too massive for innovation to stop. So the question isn't whether these sectors will grow, it's whether you have the temperament to hold through the uncertainty about exactly when and how fast. If you need certainty and smooth returns, these aren't the right investments. But if you can handle volatility in exchange for asymmetric upside, these are some of the most compelling opportunities available right now. Let's talk about position sizing, because this is where a lot of investors sabotage themselves. They find a great opportunity, they invest too much too quickly, and then when it drops, they panic and sell at the worst possible time. Or they invest too little, and even when they're right, it doesn't move the needle on their overall wealth. Here's my approach. For infrastructure plays like this, I'm comfortable allocating 10 to 20% of my investable assets to the theme, spread across multiple companies and sectors. That's enough that if I'm right, it materially changes my financial trajectory. But it's not so much that a temporary drawdown creates financial stress or forces me to sell at the wrong time. Within that allocation, I build positions gradually. Rather than investing everything at once, I'll invest maybe a third or half of my intended position initially and then add on pullbacks or as my conviction increases based on new information. This approach reduces timing risk and also keeps you engaged with the investment thesis rather than making one decision and walking away. The other key is rebalancing. As these positions grow, they can become an outsized portion of your portfolio. Nvidia investors who held from 2019 to 2024 saw their position potentially grow from 10% of their portfolio to 50% or more. At some point, you need to take some profits and rebalance, not because you've lost faith in the company, but because concentration risk becomes too high. This is a good problem to have, but it's still something you need to manage. Now, I want to zoom out and talk about the bigger pattern here, because understanding this pattern is more valuable than any specific stock pick. What we're really discussing is how to identify and invest in the infrastructure of technological revolutions. This is a repeatable framework that has created generational wealth multiple times throughout history. In the 1990s, it wasn't the flashy dot-com companies that made the most consistent returns. It was the companies building routers, fiber optic cables, and server infrastructure. In the 2000s, it wasn't the smartphone manufacturers. It was the companies providing chips, displays, and app store infrastructure. In the 2010s, it wasn't the AI applications. It was Nvidia and the cloud providers offering the computational infrastructure. The pattern is always the same. A new technology creates massive hype and speculation. Money pours into consumer-facing applications because those are easy to understand and exciting to talk about. Most of those companies fail or disappoint because competition is fierce and moats are weak. But underneath the hype, there are companies building the essential infrastructure that every application needs. Those companies quietly build moats, compound their advantages, and generate extraordinary returns for patient investors. What makes this framework so powerful is that you don't need to predict exactly which applications will win. You don't need to know whether ChatGPT or Claude or some other AI will dominate. You just need to know that whoever wins will need NVIDIA's chips. You don't need to know which quantum computer architecture will prevail. You just need to know they all need error correction. You don't need to know which renewable energy technology dominates. You just need to know they all need grid management software. This is how you turn technological uncertainty into investment certainty. You find the common dependencies, the unavoidable requirements, and you invest in the companies that control those choke points. So where does this leave us? Nvidia made millionaires by being essential infrastructure for the AI revolution, positioned at the intersection of multiple growing industries, with deep moats that made competition nearly impossible. That same pattern is emerging right now in energy infrastructure, quantum error correction, and advanced materials for semiconductors. These aren't speculative bets on distant futures. These are investments in infrastructure that's being built right now, that has existing revenue and customers, and that's positioned at the early stages of multi-decade growth trends. The companies that dominate these sectors 5 years from now are already operating today, already signing contracts, already building their moats. The opportunity is to identify them now, before their valuations fully reflect their strategic position, and to have the conviction to hold through the inevitable volatility. This is exactly how Nvidia millionaires were made, not by luck or perfect timing, but by recognizing an infrastructure pattern and having the patience to let it play out. If you found this analysis valuable, if it changed how you think about identifying investment opportunities, then subscribe to the channel because this is exactly the kind of deep dive research we do here. We're not chasing headlines or following the crowd. We're identifying structural advantages before they become obvious. And if you want to go deeper on any of these sectors, drop a comment and let me know which one you want me to break down in more detail. I can do deep dives on specific companies, valuation frameworks, or how to construct a portfolio around these themes. The next generation of millionaire investors is being created right now, in markets most people aren't even paying attention to yet. The question is whether you'll recognize the pattern in time, or whether you'll look back 5 years from now wishing you had. The information is in front of you. The pattern is clear. The only question is what you do next.